Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Option Industry Council's webinar series. My name is Nick Ziegler, a staff member here at the OIC, and I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's session on vertical spreads, we'll take a look at 4 of these straightforward option strategies and get some practical advice on entering and exiting those positions in a quick 60-minute session. Our instructor today is the OIC's Director of Retail Education, Mr. Joe Burgoyne. Joe has spent more than 3 decades in the financial industry and brings a special understanding of options and investments to the table. Please note that the windows on your desktop are resizable, so feel free to move the slides around for ease of viewing. At the top right of each box, you'll see buttons to maximize and minimize each window, so please use those, especially on the slides, so you have the best viewing experience. You'll also note that there's a box on the right side of your screen where you're able to submit questions at any point during the presentation. Joe will be responding to those questions during the final 10 or 15 minutes of today's session. Please note that this box is for content-related questions only. If you're having technical issues, the leftmost icon at the bottom, the question mark, is a link to our webcast provider's support page. Just under the questions box, you'll see a survey. Please fill it out at any point during the session so we can better serve you and investors like you with our future webinars. These survey responses are extremely important to us and will help guide our future programming. As I mentioned, there is a row of icons along the bottom of your screen. Each icon corresponds to one of the windows in the webcast, so if you rearrange your workspace and are looking for a specific part of the webcast, you can return to that part by clicking those icons. For your convenience, you can access a PDF version of today's content via a download link that's just below your slide window. And if you'd like to review the entire webinar, an on-demand version will be available a few hours from now via the same link you used to join us today. Additionally, our previous webinars can be viewed on the OIC YouTube channel. And now, ladies and gentlemen, Joe Burgoyne will bring you our topic today, vertical spreads. What are they and how do they work? Joe?
Hey, Nick, thanks very much, and well done there. And thanks, everybody, for joining us in this busy time of year. We really appreciate you making an effort to join us. So as Nick said, tonight is we're going to be talking vertical spreads, and let's get right to it. Our second slide here, just for those of you who have joined us before, know that's the disclaimer slide, and the industry does produce a booklet called Characteristics and Risks of Standardized Options. You really should get a copy of that either from the OCC or from your broker. For those of you new to OIC webinars, this slide tells you how we are funded. We are a nonprofit sponsored entirely by the listed U.S. options industry. The bottom right-hand corner, OCC, represents the clearing corporation, and the rest of the symbols there represent the 12 listed option exchanges. And so it's both the OCC and the exchanges that fund us year after year. The OIC dates back to 1992, and we're thrilled to be out here offering education and knowledge on the risks and benefits of the listed options product. One of my favorite slides here is our industry volume slide. Dates back to the inception of the industry in 1973 right through 2013. When we do our next webinar in 2014, we'll have this updated, of course, with 2014 volume. And 2014, if we continue to go the way things have been going, should be the second busiest year in the history of the industry, with average daily volume probably just under 17 million contracts a day. So today, as Nick said, we're going to talk about the 4 types of vertical spreads. Before we get into that, I'm going to go through a couple review slides. I think one thing about listed options, a lot of people think they're confusing, and really if you take your time, learning the essential concepts, and we'll review a number of them in our 6 or 7 review slides, you really build that foundation of knowledge that allows you to continue to use the listed product in a more confident way. And after we review the 4 types of slides, we'll talk real quickly about getting in and out of these different spread positions. So in terms of the review, I think we know options are financial tools. They allow investors, both retail and professional investors, to participate in the market with limited risk, limited cash outlay. Oftentimes, the listed option gives you the ability to increase your returns and to also protect profits or manage risk in your portfolio. Contract terms, of course, we've always got the underlying stock. Each option, with few exceptions, corresponds to 100 shares of the underlying. That's where a lot of the leverage comes in. We've got a couple mini options in the industry, and then the jumbo options, but the vast majority of options correspond to 100 shares of the underlying. We've got the all-important strike or exercise price. That's a critically important term in your option. Of course, there's the expiration month or week, depending on what options you choose to use, and you tie that all together, and something like XYZ Jan 50 calls would be an example of a listed option. So when we talk options, we talk rights and we talk obligations. And again, when I talk about core concepts of options, there is nothing more basic or more important than this whole idea of rights and obligations. Option buyers pay for rights, and those rights, for a long call buyer, you have the right to buy the underlying, and for a long put buyer, you have the right to sell the underlying. On the short side, we incur obligations by selling options. Option call sellers have the obligation to potentially sell the underlying, where option put sellers potentially have the obligation to buy the underlying, depending on the price of the underlying at expiration. And all these options with rights and obligations in almost all circumstances correspond to 100 shares of the underlying at the specific strike at some time before now and expiration. Our contracts, the vast majority of listed contracts, and we have, I think at this point, over 4,200 different products that are listed on the 12 exchanges. The vast majority of these equity options are American style. American style means the buyer of those options can exercise at any time, from the time when he buys that option right up until expiration. Of course, the seller, on the other hand, then can be assigned at any time. They are American style. The other type of option is European style. European style options are those that can only be exercised or assigned on expiration day, and most typically they are a form of index option. Now, the quick review point is option premium. Option prices really are made up of potentially 2 different things. Intrinsic value, if the option has intrinsic value, which is the potential in the money amount of that option, and then there is time value. So it's a combination of intrinsic value, if the option has any, and time value, and that time value is any part of the premium in excess of intrinsic value. If there is no intrinsic value, the entire value of that option is time value. And of course, once you get to expiration, if the option has no intrinsic value, meaning if it has no in-the-money amount, then it has no value. Quickly, in, at, and out of the monies. Let's take a $50 stock. At OIC, our favorite stock is always XYZ. So an in-the-money call, you will have the stock price above the strike price. So again, with the stock at $50, a 45 call, which is the right to buy stock at 45, would be $5 in the money, so that is in the money. A $40 call would be $10 in the money because that's the right to buy the stock at 40 with the stock at 50 in the open market. A $49 call would still be in the money. It'd be in the money by $1 with the stock at 50. So they're in the money calls. In the money puts, are just the opposite. The stock price is below the strike price. Let's go through it. You've got your $50 stock. A 55 put represents what? It represents the right to sell stock at 55. So it's got $5 of intrinsic value. It's in the money by $5. A 51 put, the option to sell stock at 51 with the stock at 50 would be $1 in the money, and so on. At the money calls are just as they sound, at the money. So with a stock $50, a 50 call and a 50 put would be at the money. No intrinsic value, no in the money amount. So the entire premium for those calls and puts at the money is time premium. And then out of the money calls and puts, of course, if they're out of the money, that means they have no in the money value, so there's no intrinsic value. So there also, the entire value is time premium. The calls for out of the money options, the stock price is below the strike price. So with a $50 stock, any strike 51 or higher would be out of the money because the strike is above the price of the stock. On the flip side, the puts work exactly the opposite way. So an out-of-the-money put with the stock at 50 would be a 49 strike or anything lower. And as the slide suggests, the 45 put, which represents the right to sell stock at 45, would be $5 out of the money, $5 below the $50 stock price, and of course have no intrinsic value. Intrinsic versus time, just so you have a clear understanding, in the money calls and puts, when they're in the money, they do have intrinsic value. Now, if expiration's tomorrow, maybe they don't have any time value. If they are deep enough in the money, maybe they don't have any time value. So in the money calls and puts, just like the name says, they're in the money. You know they have intrinsic value, and they may or may not have time value. As I said earlier, at the money calls and puts and out of the money calls and puts have no intrinsic value. All of the value in those options is time value. So that's our quick review. I hope you are rock solid on those concepts. If you're not, I would urge you try to get to that point. And for those of you who are, good for you. So spread basics. Basically, a spread is a multi-leg strategy. That's what a spread is. Some spreads involve only options, where you get you're buying one option, selling another, and other spreads involve stock and options. They're also considered spreads. Something like the covered call. You've got long stock versus a short call. That's a spread. And the vertical spreads that we're going to go through tonight, the 4 types of vertical spreads, they're obviously spreads, but rather than stock versus option, they are option versus option. Why are spreads important? Well, they're important because, just like the name suggests, spreads can be a form of a hedge. Not in all cases, certainly, but they do allow sometimes to give the investor an opportunity to optimize his profits, maybe more so than just buying a call or buying a put or the underlying itself. And, when you do spreads, some of the Greeks that are involved with the options, the whole theta and volatility aspect, you can hedge them through the spread trading concept. Option chains, just a not really a tool, but something that hopefully we're all familiar with. You can find your option chains at our website, optionseducation.org, or at your broker. And always good to be familiar with, how the option chains are set up and the different information that is either posted there or many of those are customizable. You may want to, if you're a little more advanced, customize your screen, so the option chain is as useful as it possibly can be. So let's get into our discussion on vertical spreads. As Nick said, we're going to talk about 4 vertical spreads tonight. That's basically how many there are, 4 vertical spreads. So what is a vertical spread? It is an option strategy where we buy one option and sell the other, typically simultaneously unless we leg, all calls or all puts in each of the spreads. Different strikes, same expiration month, okay? So we're not talking about time spreads or diagonals, same expiration, and of course same underlying stock or index. There are bullish spreads that are verticals, that are calls and puts, and they're bearish spreads that are verticals, all calls or puts. There are a total of 4 of them, and that's what we're going to go through. Vertical spreads, as I had said, really, oftentimes, I didn't say it specifically for the vertical spread, but spreads, by and large, can oftentimes optimize your risk-reward potential. And when it comes to vertical spreads, risk and reward, there is limited profit potential with vertical spreads and also limited risk. Some of these spreads are debit spreads, where obviously you're paying more for the one option than you're taking in on the option that you sold. Some of the spreads, 2 of the spreads are debit spreads and 2 are credit spreads. And in the credit spread, we're selling an option that it has greater value than the option we buy. And this last bullet here on the slide is really important, and it's one of these simple fundamental rules. The maximum value of a spread at expiration in a vertical is the difference between the strike prices. So if you do a 50-55 spread, the most it can be worth is $5. You do a 50-60 spread, the most that can be worth, of course, is $10, and so on. So the maximum value of the spread at expiration is the difference between the strike prices. So let's look at vertical spread number 1, the bull call spread, which is a debit spread. So by debit spread, we know right off the option we're buying is going to cost more than the option we sell. In a bull call spread, we buy one call, sell another call at a higher strike. Same expiration, which is always the case with the verticals, and same underlying. Always a debit. The bull call spread is always a debit because the option we're buying, the first option, is the lower strike call, and that always costs more than the higher strike call. And that little zigzag line on the right side of the screen there, that's your profit and loss potential. So you can see at some point to the upside, your potential profit maxes out, the line goes horizontal, and that's the same thing on the downside, on the left side of that little zigzag, your losses max out as well. Let's take a look at an example. Again, XYZ, stock's $63. Now, it's so often the case when we're using options, we have an opinion, we have a forecast on the underlying. In this particular example, we have a rather aggressive forecast that the underlying XYZ we expect to rise by 10% between now and expiration. So again, the stock's 63. Our spread we decide to buy is the 60-70 call spread. Now, why do we pick the 60-70? We could have done the 65-70. We could have done the 60-65, 55-70, all kinds of different strike prices to choose from. But I think it goes back, from my mind, it goes back to the price of the stock. Stock 63. We're looking for the stock to go up 10%, $6 or $7. So that takes us up into the high 60-70 range. So oftentimes, we want to be sure to strike at the price of the stock at expiration. So that's where, understanding that we want to be short the 70s if our forecast is right is going to optimize our profit potential. And then we decide to, buy the $10 spread, the 60-70 as opposed to the 65-70. And let's take a look at it. So we buy the 60 call for 5.5. We sell the 70 call for 2. Net debit is 350, and that's really the only number I care about as an option user. What's my debit? What's my credit? It allows me to get to the break-even points far more easier rather than kind of figuring out each option individually. So try when you're doing these spreads to think conceptually, with your debit or credit. And again, in this example, our debit is going to be 350. So we've bought the 60-70 call spread for 350 plus commissions. So let's take a look. That's 63.50. And that's how we do with a 60 call. There's the 70 call. We started at 63.50 because that's our break-even point at expiration. Our debit on this spread is 350. If our forecast is wrong and the stock doesn't go to 70 or it doesn't go up at all, but in fact turns and tanks, we know that the most we can lose in this spread is the debit we pay, which is 350. So with the stock at 60 or 55, you can see we've lost the debit we've paid. If our forecast turned out to be partially right or 100% correct, you can see at 65, that spread would be worth $5 because the 60s would be 5, the 70s would be worth nothing. So you'd have a $5 value. We paid $3.50. That's where the $1.50 profit comes in. Between 65 and 70, we're making more money. And then you can see above $70, we max out on the profit potential at $6.50 because the difference between the strikes was 10. We paid $3.50, so our maximum profit can be that $6.50. And again, this whole idea of the P&L chart, the blue line, good idea if you can possibly, as you put on any option strategy, whether it's a straight call, straight put, or a combination trade, have a sense in your mind, where your break-evens are. So I mentioned, our maximum profit's the $6.50, maximum loss is the debit we paid. How we figure out the break-even is we take that lower call strike and we add the debit, the $3.50. So it's the 60 strike plus the $3.50 debit gets us to our break-even point at $63.50. So conceptually, just think now, if our forecast was wrong and the stock's below 60, well, the 60 call is the right to buy options at $60 or higher. If the stock's below 60, that option has no value. So we know the value of the 60-70 call spread will be 0, and we'll have lost, our entire $3.50 debit. If the stock at expiration is somewhere between 60 and 70, we're going to have intrinsic value in the 60 calls. There will be value there. So it's just a question that, what level does the stock expire? And if it's 61, we know that the 60s are worth $1, the 70s are worth nothing. We paid $3.50 for the spread. Our break even was $63.50. At 61, we'll have lost $2.50, and so on and so forth. Right up between 60 and 70, I think you can see it's pretty easy to figure out how you've done. And then the stock above 70, well, our forecast was the stock was going up 10%. In fact, it did, and maybe a little bit more. So the 60s are going to be worth above 70, depending on how high the stock goes. They've got lots of intrinsic value. But as we go above 70, so do the 70s. So, again, it gets back to that core piece of knowledge where the difference between the strikes minus the debit is the maximum profit for the trade. So in this example, it's that 10 less 350. Our maximum profit's going to be $650, which is a home run. Now, I mentioned earlier the whole idea of spreads. They can optimize your potential risk-reward ratio. Let's take a look at the idea of choosing a couple different strategies here. We got XYZ, which is 63 bucks. Again, we think the stock's going up 10%, so it takes us up into the neighborhood of 70 bucks by expiration. A couple different strategies. We could buy the stock at 63. Stock goes from 63 to 70. You do awful well. You could also buy just the 60 call, and as you may recall, the price of the 60 call was $5.50, and then what we did, we turned around and bought the 60-70 call spread for $3.50. So let's take a look at some of the returns there. Stock goes from 63 to 70. You make $7. It's a heck of a good trade. Chances are you had to tie up quite a bit of money, whether you're doing that by putting up $6,300, whether you're doing it on margin, you're tying up a fair amount of capital. And importantly, you've got $63 of risk. Don't forget that. Now the 60 call, buying that for $5.50, the stock goes to 70 at expiration. You make $4.50, almost double your money. That's a home run in my book without question. But let's look at the spread that we put on, the 60-70 call spread. We paid $3.50. Our forecast was right. We, far more than doubled our money with a $650 profit. And without question, that's a far, far better trade than just buying the 60 call, because right out of the box, we've got a whole lot less risk. We're risking $3.50 versus $5.50. And we make more in the end as well. What is the potential upside? There are always trade-offs, or there typically are, depending on what option or option strategy you use. If the stock went to 80 and you own that 60 call and you didn't get out at 70, then you'd stand to make far more money. But that's not what the forecast was. The forecast was for the stock to go from 63 to 70, and that's why this 60-70 call spread really makes more sense than either of these other potential trades. And that's why vertical spreads can be so compelling. When you're typically looking for a particular move up or down in an underlying, these vertical spreads can really be the best way to go. So that was the bull call spread. Let's take a look at the bear call spread. Now the bear call spread is a credit spread. So right away you should realize that the option we're selling is worth more than the option we're buying. And how do we construct this? You can see it's the exact opposite P&L chart as we showed with the bull call spread. In the bear call spread, we buy one call, sell another, but we sell that other with a lower strike. And when the call has a lower strike, it has more value. That's why this is a credit spread. Always same expiration, same underlying, and as I mentioned, the bear call is always going to be a credit. Let's take a look at XYZ, still at 63, but a far different forecast. We're neutral to bearish on the underlying, and so we decide to sell that 60-70 call spread for $3.50 rather than buy it. Let's take a look again, 63.50. Hopefully you remember that was our break even. Now, if our forecast on XYZ, which was neutral to bearish, goes awry, depending on how far awry it goes, we could lose up to that $6.50. Again, the difference between the strikes, less the credit we take in. If our forecast goes against us, hopefully, we've got trading discipline and a particular level in the stock where we would close out that vertical spread at a loss as opposed to just letting the stock run away. But, that gets back to, how each of you as investors manage your different option positions. The forecast was neutral to bearish. If, in fact, the stock dropped, we sold the thing for $3.50. That's the 60-70 call spread. If the stock is 60 or below, certainly that $350 is going to come our way. So maximum profit, which is always the case with a credit spread, always, you can't make more than the credit you take in. So if we sold that spread for $350, the maximum profit potential is that $350. On the flip side, we know the math. If the difference in the strikes is $10 and we take in $350, we do have exposure of $650, which from a risk-reward standpoint make $350 to potentially lose $650. I don't like that ratio, but again, that's where managing a position comes in. If you're wrong about your forecast, hopefully you close that thing out long before the stock goes to 70 at expiration. And then our break-even is going to be that lower call strike plus the credit received will get us that 60 plus the 350 credit, so a break even at 63.50. And as you can, hopefully you can tell, the bull call spread and the bear call spread, there are lots of similarities in terms of how they work and the concepts that are at work with each of those respective spreads. So that's the bull call and the bear call. Let's take a minute, if you would, with 5 quick questions. Number 1, vertical spreads may use options in different expiration months. Is that true or false? I hope you answered false. Always the same expiration month for a vertical spread. Vertical spreads have unlimited profit potential. True or false? I think hopefully you think these are easy questions because I've said repeatedly the maximum profit or loss is the difference between the strikes. So vertical spreads do not have unlimited profit potential. Number 3, XYZ, the 30-35 bull call spread. We buy it for 30 cents. What's the maximum profit possible for this spread? The 30-35 call spread we pay 30 cents for. Well, the difference between the strikes is $5. If we paid 30 cents, the maximum profit would be $4.70. And that's the maximum profit. Now, in order to buy that 30-35 call spread, and I'm getting a little more advanced here, to be able to buy that call spread for 30 cents means that the stock is going to have to be significantly below $30. That's, so that call spread for 30 cents would be way out of the money and would suggest that stock would be somewhere in the mid-20s. So you'd have to get, you'd have to have quite a run in that stock for the stock to go from 30 cents to $5. But really the point of the question is just to understand the difference in the strikes is 5. We paid 30 cents. Maximum profit potential would be that 470. The bear call spread anticipates what kind of move in the underlying? Up, down, or sideways? Well, bear call should be the hint. When we talk bearish strategies, we're talking to the downside. So a bear call spread would anticipate a downside move. And lastly, XYZ, the 30-40 bear call spread is sold for 4. What's the maximum profit potential and the maximum loss? Well, why don't we start with that? Maximum profit potential, selling the 30-40 bear call spread for $4. Well, our credit is 4. We know the most we can ever make in a credit spread is the credit we take in. So our maximum profit is 4. The difference between the strikes is 10. So our maximum loss potential is $6. And our break-even point is going to be that 30 strike plus the $4 we take in. So our break-even point at expiration is going to be 34. 34 and lower, we make money, less commissions. Above 34, we're not making money. So there are a couple questions. Mix it up a little bit rather than just have me do all the talking. Hopefully And actually, Nick mentioned the surveys. If you like the whole idea of the Q&A, please, let us know if you wouldn't mind. Two more of these. We got the bear put spread. Okay, so the bear put spread, also a debit spread. That should be a hint as to what we're doing here. The bear put spread, just like all vertical spreads, buy one put, sell another. With the bear put spread, we're selling the put at a lower strike, and so the higher strike put, where we have the potential right to sell the underlying at that higher strike, it's a more expensive option. That's why the bear put spread is always a debit spread. Same expiration, same underlying. As I mentioned, always a debit. Back to good old XYZ. Now the stock's 39. Our forecast, we're looking for the stock maybe a downside move of 10%. So if we take 39 times 10%, that's almost $4. That takes us down to a strike of about $35 in the underlying. So we decide to buy the 35 put spread with the stock 39, and we pay $1.50 or $1.50 debit for that spread. And again, the forecast allows us to assist in choosing the strikes, and I think that's very important. So our break-even point, surprise, surprise, might be that higher strike at 40 minus the debit paid, $1.50, gets us our break-even at 38.5. Now the bear put spread, again, the forecast is for the underlying to go down. So if the underlying happens to go the other way and goes up, we'd expect to lose money. We've paid $1.50 for this debit spread, so we know no matter how high the stock goes, the maximum loss for this vertical bear put spread would be the $1.50 debit we've paid. To the downside, at 35, we'll have made $3 or $350. Again, the difference between the strikes is 5. We paid $1.50, so we're going to max out our profit at 3.5. And again, that's the P&L, and we mentioned the maximum profit and loss. And a break even, I mentioned it's that higher strike minus the debit paid gets us to 38.5. So just to review, XYZ, if the stock's above 40, again, we started, the stock was at 39. The forecast, we anticipated the underlying to head down towards the mid-30s, maybe 35 or so. If the stock goes the other way, we'd expect our trade to lose money. And in fact, if the stock's above 40, we know that the 40 put, which is the one we're long, has no value at expiration, so we would lose the whole $1.50 debit. Anywhere between 35 and 40, we know that this 40 put has intrinsic value because, again, what's the 40 put? On the long side, when we own the 40 put, it's the right to sell stock at 40. When that stock is anywhere below 40 at expiration, there's intrinsic value, and so there is value to the spread. If the stock's at 39, the value of that spread's going to be, I hope, you get $1. The 40 put's worth $1. The 35 is worth nothing. If we paid $1.50 for the spread, we'd have lost 50 cents or $50 on that spread. At 37, again, $3 below the 40 strike, that spread's worth $3. We paid $1.50. We'd have doubled our money at a $3 profit. Because we paid $1.50, and the value of that spread would be $3 with the stock at 37 at expiration, and so forth, all the way down to 35. And then if the stock is below 35 at expiration, both options will be in the money, and that's where the long put and the short put, will exercise the 40 put, be assigned on the 35 put. They will offset one another, so the position will, wash itself out, but we'll be fortunate enough to have made $350 with our $150 investment because below 35, the value of the spread is going to be the maximum distance between the two strikes. Again, let's look at choosing strategies and our different choices there. Stock's 39, forecast we know for the stock to decline by 10% by expiration. Well, we could short the stock at 39. Shorting stock, for those of you who don't know, investors, and you have to have a relationship with your broker, but you can actually sell the stock before you own it. That's called shorting a stock. You have to put up an awful lot of capital. It depends on your relationship with your broker, but you have to put up quite a bit of capital to short stock. And importantly, how much risk? Well, there's theoretically unlimited risk because, again, theoretically stocks can go to infinity, but the short stock is one potential strategy. Another strategy would just be to buy the 40 put and to pay, in our example, the value of that 40 put was $2.50. So that's one strategy as well. And then we get back to the vertical spread, the bear vertical spread, where we buy the 40 put and sell the 35 put, and we do that for a $1.50 debit. And just like in the bull call spread earlier, you can see if we shorted the stock and it goes from 39 to 35, sure, we're making money, but lots more risk, lots more capital tied up. So that's a whole different, type of trade. The 40 put, is a wonderful trade. If the stock goes to 35, you double your money. But the fact is, it's not as good a trade if the forecast, in fact, is for the stock to go to 35, not 30. Because with the 40-35 put spread, you're risking almost half of what you were with the 40 put, and you're actually making more money. Where rather than risking 2.5, you're putting up $1.50, and you get a maximum profit of $3.50 versus $2.50 with the 40 put. So that's where these vertical spreads again can be wonderful strategies. Depending on your forecast for the underlying. And our last vertical spread is the bull put spread, which is a credit spread. So, of course, we know that whatever option we're selling in this combination is going to be valued more than the option we're buying. The bull put spread, much like the bull call spread, has that same type of P&L chart. Make money to the upside, lose money to the downside. The bull put spread, we buy one put, but we sell the other put with a higher strike. And with puts, the higher the strike, the higher the value. Always, of course, same expiration with the vertical spread, same underlying, and always a credit because the lower strike put always costs less than the higher strike put. Let's look at the example. XYZ 39, different forecast. We're neutral to bullish rather than bearish. So we decide to sell the 40 put, buy the 35 put. We're taking in that $1.50 because of the forecast as opposed to paying the $1.50 when we have a downside forecast. So that break even is going to be just the same at $38.50. If the stock goes the other way and goes down rather than up, we stand to lose up to $3.50. That difference in the strikes less, the credit we've taken in. And we know if our forecast is correct and the stock does head up, we stand to make up to $1.50, which is the credit we took in for the spread. Maximum profit, maximum loss we discussed. That break even at expiration is that higher put strike minus the credit received. So it's that 40 minus the $1.50 that gets us to that $38.50 level, which is the break even. Again, bear and bull put spreads. There are a lot of things that are reciprocal in each of those spreads, and they just something to be aware of. So before we wrap up, a couple more questions for you on these last two verticals. Is a bear put spread a debit or a credit spread? A bear put spread is a debit spread because in the bear put spread, we're buying the higher price strike and selling the lower price strike. A 50-45 bull put spread bought for $250 can make how much profit? Well, difference between the strikes is $5. We paid $250, so the most we can make is $250, and the most we can lose is the $250 debit we paid for the spread. A bull put spread anticipates the underlying moving which way? A bull put spread. Well, on the one hand, puts often, when you think puts, and this is where to me options sometimes get confusing, puts generally you think of the underlying going down, but when we're talking about a bull put spread, bull's the key. The bull put spread means that we're going to sell the higher strike put, buy the lower strike put, and therefore we're looking for that underlying to rise. And that's the direction that we're looking for with a bull put spread. And why use vertical spreads? Well, I would say, vertical spreads are excellent choices for strategies based on particular forecasts of the underlying. And as we have compared different strategies, you can see from a risk-reward perspective, they can be awful effective. So there are the four spreads, the four vertical spreads. Let's talk quickly about getting in and getting out of these spreads, and then a quick wrap. Trading spread as a spread, meaning when we do a spread, whether it's stock and option or option to option, when you do a spread, each side of the spread is called a leg. And so sometimes you can do them simultaneously, and that's really oftentimes the best way to do it because it's the least amount of risk. And, it's maybe a little easier to get a price on that spread just by doing it simultaneously as opposed to, trying to leg it and leaving yourself hanging out to dry in terms of some of the potential risks as the underlying moves. Maybe you've got the wrong leg on first and the spread will end up costing you more rather than less if you've legged the wrong way. So again, that's really what the next slide talks about, legging one at a time. And one thing, especially, on if you're going a leg, it's always less risky to do the buy side first, because if you do the sell side first and then something crazy happens, short options have far more risk than long options. So just be aware of that. Also, if you get into this idea of legging, you have to be careful that at the end of the day, you don't just have yourself hanging out to dry there with a short option position. Because if you do, oftentimes, unless you have that type of status with your broker, you can get into problems that way as well. So just be careful how you put on the spreads. And then in terms of pricing a spread in the marketplace, that's just common sense. In our example, we've got XYZ, the May 60-65 bull call spread. You can see the 60 calls are 4 bid offered at 410. The 65 calls are 1 bid offered at 110. So the bid offer spread, if you take the offer of the 60s and the bid of the 65s, the offer is going to be 310. If you could buy the 60 calls at 4 and sell them on the offer at 110, you'd be doing that spread on the bid side for 290. So the spread market in this example is going to be 290 offered at 310. It's up to you, and the value of that spread is going to change as the underlying moves. Remember, option prices are driven by the price of the underlying. And so if the spread goes, if the underlying goes down, the value of that call spread is going to go down. If the value of the underlying goes up, the spread's going to go up. So oftentimes I'll be asked, should I just buy it at the offer? Should I buy it at the market? Should I work the spread? It really depends on a couple things. Number one, your opinion of the underlying. Do you think it's just going to, sit in its current, price range, and if so, then maybe you can just work the spread a little bit. If you think the thing's going to run away, then you just have to be more aggressive. So again, how do you price spreads? The marketplace will price the spreads for you. What you land up buying or selling the spreads for is really where the art comes in, and it starts with your opinion of the underlying while you're placing that order. So just a couple things as we wrap up. Try to know risk reward of vertical spreads and any position you put on as an investor. Try to go through the what if scenarios. And at our website, optionseducation.org, we have the free position simulator tool. You can do any what if you want. So I would urge you, if you've never used the position simulator and you really do believe that options are for you, go to our website, optionseducation.org. On the drop down bar under tools and resources, you'll find the position simulator. Use it, get comfortable with it, and help build your profits. With regards to your relationship with your broker, having approval for complex strategies is important, and be sure that you're approved for spread trading. Oftentimes with any investment, you need a forecast, and with options, you certainly need a forecast and a sense of time as well. Try to be, half decent with a couple different strategies, and my rule is always, there are three opinions we can have for an underlying: bullish, bearish, or neutral. Try to find two or three different option strategies that fit the bullish camp, the neutral camp, and the bearish camp, and then get very, very good at them. Try to stay flexible, and as the slide says, an account with no buying power has no flexibility to adjust. So you're backed into a corner and losing money. Try to, stay out of that extreme situation. Maximum margin has been known to lead to maximum trouble. So, a lot of instructors caution investors to not trade too big. Don't trade too big. No option strategy works 100% of the time. That is true. And also, no one ever went broke taking a profit. And that's very true. But I got to tell you, when you take a profit and then you see that thing keep going and going and going, and you took your profit a little early, that can be painful, but it is true. No one goes broke taking a profit. Customer requirements, I think all straightforward, but those last couple, know your broker and let your broker know you, are darn important. And then just before we turn it over to Nick, if you're not familiar with our website, it is optionseducation.org. We have an enormous reservoir of different ways to learn about options. There's also something on the website called My Path Education. It's a 20-question assessment where you take the assessment. We'll let you know whether you are at a basic, intermediate, or advanced level, and with that, we will download lessons to you that you can take at your leisure. So that is My Path Education on our website. Of course, our good friends at Investor Services can be reached 5 days a week at 888-OPTIONS. And I think, as Nick has mentioned, we've got a mobile app and also a YouTube channel. So that will wrap up tonight. I guess maybe we'll have a few questions. And Nick, I'll throw it over to you.
Great. Thanks, Joe. Thanks for all the time and expertise today. And we do have a number of questions, but before we get to them, I'd like to remind our listeners that you can fill out that survey that's on the right side of your screen. That information is going to be very helpful to us as we start to plan our 2015 webinar series. And speaking of the 2015 series, this is our last session for 2014. So if you've been attending throughout the year, thank you for your support. We hope it's been helpful on your options journey. And of course, as Joe mentioned, if we're not able to get to your question today, you can always give our Investor Services team a call at 1-888-OPTIONS during normal business hours. They're always ready to help answer questions about options, strategies, or positions. And with that, Joe, we do have a number of questions, some fairly seasoned investors we've got on the call today. So the first question we have here: in a bull call spread, If the upside call sold is not assigned, does it just expire worthless and the entire credit is retained by the seller? Is that what happens?
In a bull call spread, Nick?
Correct.
Okay, in a bull call spread, if the short option is not assigned, then the value of that spread is going to be less than the distance between the strikes. So, and this is a great question because actually I didn't touch on this in the presentation. On the long side, the long call position, we're going to be long stock. If we are not assigned because the short call is still out of the money, unless we close that position at expiration or before, then our position coming in Monday morning is going to be long stock, a completely different position in terms of risk, because now we're long stock as opposed to a $2 or $3 or $4 debit spread. And also there's going to be a whole different capital requirement from your broker to be able to hold that long stock. So that's how it works.
Joe, does volatility play any part in the selection of one of these vertical spreads versus another?
Interesting question, Nick. Let's go back to what a vertical is. You're buying one call, selling another, buying a put, selling another. So unlike straddles and strangles and long calls and long puts, volatility plays less of an impact or has less of an impact because we're buying one, selling another. So in essence, you're hedging that volatility position. There is still going to be some, long or short vega in the position depending on whether you've bought or sold the spread. But the impact of volatility is far less than many other option positions. Again, because we've bought one, sold another, and with that, we've offset a lot of the volatility risk.
Joe, are there any vertical spreads that have unlimited profit potential, or they all have kind of a cap on them?
They definitely all have a cap, Nick, and the cap is the strike price is chosen. Vertical spread, buy one strike, sell another, sell one, buy another. So you may have, in a high price stock, maybe you've got a $30, $40, or $50 vertical spread. And, depending on what you pay, the max can be a lot more than $5 or $10, but it cannot and will not exceed the difference between the strikes. So there is no vertical spread with unlimited upside potential. It's always the difference between the strikes less the debit or credit.
Joe, let's talk a little bit about assignment risk. What is the assignment risk if the stock is at the short strike?
Okay. Another good question. We touched on it in question number 1 a little bit. So let's take the long call spread. We're long an in-the-money call, and we're short the at-the-money call. And let's go back to our first example, the 60-70 call spread. Stock's at 70 at expiration. We're going to be long stock with the 60 calls, and then the 70 call with the stock right at 70 at expiration. We're not sure whether we're going to be assigned or not. So that's where this whole idea of assignment risk comes in. We really, a short option position does not control its own destiny unless you close out the position. So with the stock at 70, being short the call may, it may go out worthless on Friday of expiration, but, because the stock's right at 70, you may be assigned. And if you're assigned, then if you had the 60-70 call spread on, the long stock from the 60 would be offset by the assignment of the 70. But if you weren't assigned, then again, you'd come in, to trading on Monday just long stock because of, the exercise of the 60 call. So the way to manage that assignment risk, and again, by assignment risk, it's, we're short the option at the strike, and we're not sure whether we are going to be forced to deliver on our obligation, which with the short call is to, sell stock at 70. The way to manage that risk, and it's really what investors should do, is to close that spread. And if the value of the spread is $10 because the stock went out at 70, chances are you're going to sell that spread for $9.95 or $9.90, something less than 10, but at least that way you've controlled your assignment risk.
Thanks, Joe, and we're coming up right at our 60-minute time, but I think we'll be able to take one more question here, and I think this is a very applied question. I think it's a good one to end on. So this investor is bullish as to what's going on with the underlying, but what do you think of a strategy such as using the proceeds from a bull put spread to finance the purchase of a bull call spread?
Proceeds from a bull put spread to finance a bull call spread. I mean, assuming there are proceeds, that certainly can work, Nick. And it's actually rolling proceeds into different strategies is essentially, to a point, playing with house money, and to me makes an awful lot of sense.
Thanks so much, Joe. Do you have any final words for our listeners today?
No, I think, Nick, just as you said, this wraps up 2014. We want to thank really the many thousands of loyal listeners. And the one thing I would say, if you like what you're doing, please tell your friends and have them join us in 2015.
Ladies and gentlemen, thank you so much for attending today. As Joe mentioned, the position simulator on the optionseducation.org website is available under the Tools and Resources drop-down at the top menu. Again, today's session will be archived and should be accessible within a few hours using the same link you used to join us today. Additionally, our 2014 webinars are available on OIC's YouTube channel, so you can review a number of options, strategies, and concepts at your own pace. As I mentioned earlier, if we weren't able to get to your question, feel free to give our investor services desk a call at 1-888-OPTIONS during normal business hours. This is our last webinar for 2014, so make sure to check optionseducation.org in the upcoming weeks for details on the 2015 sessions. Ladies and gentlemen, thank you again for attending, and we hope to see you again next time.